Hello everyone, and thanks for joining us. I'm glad you could be here. I am Kevin Charapp. I'll be your host for today, and this is the first part of our series of How Do I Know If I Should Refi? And today we're going to cover part one, which is understanding the effects of reducing your interest rate. Now there's 5 major reasons why people refinance. The first is to reduce their interest rate. Next is to get a lower payment. A third reason would be to refinance out of an adjustable rate mortgage or an interest-only mortgage. The next would be to shorten the term of your mortgage. And then finally, we'll cover taking some of the equity out of your house to either use that money or to consolidate some debt. So this is part one, and I hope you enjoy it. Thanks. Let's begin our discussion about the effects of reducing your interest rate by taking a look at a simple example of how changing your interest rate by 1%, in our example from 6% to 5%, will actually lower your payment. Now please understand, all of the examples that we use throughout this presentation are just for the purpose of illustrating how interest rates affect your mortgage. This is not specific to your scenario. If you'd like more information about what you could possibly do with your interest rate and to affect your mortgages, feel free to give me a call or look me up at letkevinhelp.com and we'll answer all your questions. So the simple example is a 30-year fixed rate mortgage for $200,000. Now the payment at 6% interest is roughly $1,200 a month. That same $200,000 loan at 5% interest, the payment is only around $1,073. That's a difference of about $127 a month. Now, $127 a month is a reasonable amount of money, but it's not a huge lump sum. In fact, quite often when people consider should they refinance to reduce their interest rate, they take a look at, hey, I'm only saving $127 a month, but my loan balance is going up $4,000 or $5,000. Why would I want my loan balance to go up $4,000 or $5,000 to only save $127 a month? And a lot of people make the fatal mistake of not looking at the bigger picture. So let's take a look at the bigger picture and keep in mind that $127 a month. To begin to understand the bigger picture of reducing your interest rate and how it affects your loan over time, this is an example of that same loan we were just talking about, a 30-year fixed for $200,000 at either 6% or 5%. In our example here, you can see, and again, remember, this is just an example, but in our example, you can see after 36 months of paying the $1,200 at 6%, you've paid a total of $43,200 and you've reduced your principal balance by about $7,800. Now, at the 5% interest rate on that same loan, you've paid only $38,600, but you've reduced your balance by about $9,300. So if you combine the amount of money you saved in payments and the increase in equity, that's about $6,100 in just 3 years. So as you can see, even though it's only $127 a month, after 3 years, you've more than made up whatever costs were associated into increasing your balance to refinance to the lower rate. Now at this point, by continuing to save money year after year, you're also paying less interest in total. It turns out to be somewhere over $40,000 over the 30-year period. So as you can see, it may only be $127 a month, but the long-term effect of paying less interest on that money is much greater than the minimal cost that goes into the loan balance. So as you see, this is a good example of how lowering your interest rate can really impact the amount of money you spend over time. At this point, some of you may be saying, yeah, that's all great, Kevin, but I really don't need to lower my payment. I'm just fine making the payment that I'm making. So let's take a look at an example of how reducing your interest rate but keeping your payment the same can have an even bigger impact than paying a lower payment. So let's again consider $200,000 at a 30-year fixed rate and the 6% compared to the 5%. But this time, instead of paying the lower payment of $1,073, you're still going to pay your $1,200 payment as if it was a 6% loan, but you're going to pay it on the 5% loan. Now, after 36 months of paying the same $1,200 that you were already going to pay at 6%, but you've reduced your interest rate to 5%, you've paid off your balance by more than $14,000. Now, the difference between what you've paid off by paying the $1,200 at a 5% interest rate or the $1,200 at a 6% interest rate is about $6,300 in equity. So that's a $6,300 in equity difference just by paying the same payment you were already paying. So you may look at the situation and say, my loan balance is going to go up because there's attorney fees and because I have to have an appraisal and because I needed to pay a discount point to get that 5%. But by keeping your payment the same, you've eliminated that increase over the 3-year period, and look at what you've started to accomplish. If you continue to pay that same $1,200 payment that you would have been paying on the 6% loan, but you pay it towards that 5% loan, you're well on your way to having your house paid off 6 years earlier than you would have on the 6% loan. Because you've been reducing the principal month after month after month, you'll actually have that house paid off in about 24 years. That's 6 years of not paying $1,200 per month. That's 72 months of not paying $1,200 a month. That works out to a savings of over $86,000. Now that's a lot of money no matter who you are. So to find out more about how you can personally affect your situation and improve your mortgage, please feel free to give me a call, or you can look me up online at letkevinhelp.com. Thanks so much. I hope you enjoyed this. I hope it helped you out and gave you some good information, and I look forward to hearing from you. Keep an eye open for the next part of How Do I Know If I Should Refi? Bye, everybody.